Hello, welcome back to episode 102 of the Truetalks podcast. Today, I'm Jaylin, one of the co-hosts, and I'm joined with
Darian.
And we have a very special guest today, Professor Cannon. Woo! But yeah.
Yeah, we're thrilled to welcome Professor Bradley Cannon from Binghamton University. And he's an expert in behavioral finance and also household finance, whose research uncovers the surprising ways our brains influence our wallets.
But yeah, why don't you, that was a brief introduction on our end, but why don't you introduce yourself?
I'm sure there's parts that we're missing.
Yeah, I don't know exactly what to say. So I'm Professor Brad Cannon. So I've been at Binghamton University for 3 years now. So I'm pretty fresh still. Before Binghamton University, I was at BYU for a couple of years. Prior to that, I did my PhD at Ohio State in finance. And just like you guys said, I enjoy behavioral finance, household finance, and I don't know, most all of finance generally.
Yeah. But I have a question for you. Like, what sparked your initial kind of interest in finance? Was it like in high school or like, I guess like later down the line in college where you realized that it's something that you actually wanted to do for the future?
Yeah, that's a good question. Honestly, I went into my undergrad as a math major.
Oh.
So I started out doing math. I got a scholarship in math. And after about a year, I said, I don't want to just do math. And so I was trying to decide what to do, honestly. And my mom's like, oh, there's accounting, there's finance. And so it was honestly because of her that I kind of looked into finance and accounting. And I decided finance is, I don't know, sexier, more interesting, more fun questions. And so that's kind of what sparked my initial interest in finance. And so after getting into it, I saw that having, I guess, a quantitative background is very beneficial in finance for specific jobs. And so I was able to use the skills that I had and found it useful to answer questions that I thought were interesting. So
Love that. I feel like for a lot of undergrads, they don't realize what they want to do, but they often feel pigeonholed to select a certain thing and stick with it for the rest of their career. So I'm great that that you found that out for yourself. But for someone that might not know what behavioral finance or household finance is, and it sounds like fancy buzzwords, could you give like a brief rundown of what they are?
it is just buzzwords now. No, behavioral finance is basically, I guess the way that I think about it is behavioral finance is applying psychology to finance. And so we like to think of ourselves as being these rational beings who always make correct decisions, but the way that we evolve, the way that we think about things, the way that our emotions are impacted, we often make decisions that are, I guess, not as rational as we would like them to be. And oftentimes we don't even realize this either. I guess you could say we're programmed in a way to make decisions fast in some senses. And it can be painful to think about finance decisions. It takes a lot of work to think about it carefully. And so a lot of times we just use rule of thumbs. And what I like to do is see how these sort of, call them heuristics or biases, how they influence our financial decisions, if they actually affect stock prices. And that's kind of what behavioral finance is. As far as household finance goes, household finance is the decisions that individuals make. So when we think about like research in finance generally, we could think about, okay, what happens to stock prices? How do companies make decisions about their finances? What household finances instead is like, how do you and I think about our financial decisions? So it's much more applicable to the everyday person. But yeah, that's how I explain behavioral finance and household finance.
Yeah, that's a very good answer. And I think like from your answer and your description, I feel like I more fully understand the actual definition of those buzzwords. And for the average listener, I think they would as well. But as somebody that's into stocks and just like my own personal finance as well, I feel like what you said is actually very important to like, I guess people that invest in the stock market and are like trying to analyze how stocks move, and I feel like that actually does play a big factor. Can you like elaborate on something that I guess would affect a stock price based on someone's behavior?
Yeah. So there's kind of two aspects to that. So one, you could think about how stock prices affect people's behaviors. And another way that you could think about it is how do people's behaviors affect stock prices? And so I've kind of studied both aspects of it. I think the first question is kind of more interesting. How do stock prices affect what you and I do? So a lot of my research is actually on how you and I respond to returns. So when I see a price goes up, do I think that return is, or that stock price is going to continue to go up? Or do I think that, oh, now that it's high, it's going to come down? And so there's different opinions, there's different theories out there about what people believe, but one of the things that I've studied is what's considered return extrapolation, which is this idea that when prices go up, investors think that they're going to continue to go up. And so if you think about this, this is like perfect with cryptocurrency, right? Like a few years ago, you see Dogecoin go up. You hadn't heard about it before. It goes up 100, 200%. Now you're aware of it. Your friends talk about it. And so you're like, oh, it went up in the past. Maybe it'll continue going up in the future. And so you continue to buy in as well because you think it's going to go up. And this creates this sort of bubble where the price is above what could be reasonable. But over the long run, you can't sustain this level of like exuberance or excitement. And so it's a matter of time before that price comes crashing back down to sort of what more reasonable levels are. And so that's one example of how I think prices impact behavior, but then because people behave in a certain way, it then impacts prices again.
Mm-hmm.
Does that make sense?
Right. Like sort of expanding it beyond investing. This is kind of a mind trap that affects us in our daily life, and like shopping, even saving, or maybe budgeting when we go down the grocery store.
Yeah, absolutely.
Yeah, and I think we even learn about a little bit about like the bull market, the bear market. That's related to what you're talking about, right?
Yeah, absolutely. So yeah, it's just tricky. So like another example of investor irrationality, something that a lot of people do. So when we buy a stock, we see if it goes up and down, right? We track it on Robinhood or Charles Schwab, Fidelity, whatever brokerage account you have. And when the stock goes up, we feel good about that, right? And when we sell a stock that goes up in value, it kind of makes us feel good because we're like, hey, I was right about that. It went up. Whereas in contrast, when we have stocks that go down in value, we're kind of a little reluctant to sell it because it's kind of admitting defeat. Because once you sell it, it's like, oh man, I made that choice. I shouldn't have bought it. But when you haven't sold it yet, there's still this hope that it's going to go up in value, right? And so if we look at what trades individual investors make, investors do this. They're far more likely to sell stocks that have gone up in value than those that have gone down in value. And thinking about this, you're like, yeah, this makes sense because like those that have gone up in value makes me feel good. Those that have gone down in value kind of makes me feel bad about myself. But as a strictly rational investor, it's unambiguously better to sell stocks that have gone down in value. The reason for this is because of taxes. So if you sell something that has gone down in value, now your income is lower than it would have otherwise been. And so you're taxed on less income. Whereas if a stock has gone up in value, you're taxed on those stocks, and so your income's higher. And so investors actually do the opposite of what would be considered, I guess, more rational behavior.
Absolutely. Like I personally relate with that a lot. I feel like it's a lot easier to, it feels good to get some profit rather than cut your losses. But you would encourage the average retail trader to sell their losses more often?
Yeah, so I guess there's a couple things that I guess I would mention. So far and away the best advice for your average investor is buy and hold. Buy and hold an ETF. So the most important thing for individual investors is to get good diversification. You can do that by buying a whole bunch of stocks. But as a college kid or a young professional, we don't have all the funds to buy a whole bunch of different stocks. It's kind of hard to manage. And so when you buy an ETF, what you're essentially doing is you're giving a pool of your money to an institution that invests that money in a set of stocks. And so if I put $1,000 into an ETF, that money is going to be divided up into, let's say, 500 stocks if it's the S&P 500 ETF. Does that kind of make sense?
Yeah, definitely. How ETFs are a good way to diversify and also reduce the risk. And oftentimes it actually outperforms the average investor that tries to time the market. I remember looking at a study like that.
Yeah, so like, honestly, like one of the most, I guess, most robust findings in finance is that like if you trade a lot, you're not going to beat the market. It's really, really hard to beat the market. And if you think about it, you as an investor, so let's suppose like after you guys get your jobs, you decide, okay, I want to invest on the side, right? You can look into some companies. You're like, okay, let's say I think Apple's going to do well. You go and buy Apple. The thing that a lot of people don't realize when they're investing is that why would you have better information about Apple than BlackRock, than Goldman Sachs, than all of these asset management companies that have trillions of dollars, that have hundreds of investment managers that are being paid 6-7 figure salaries, that research all day? Their job is to find stocks that are undervalued or overvalued. And what you're doing when you're buying a stock or selling your stock is you're saying you think you know better than the person you're buying it from. But why would you know better than these people who are spending their entire life, who have spent their entire careers doing this? And so this is sort of like the motivation, in my opinion, to buy ETFs, because there's people whose entire jobs, there's companies whose entire jobs are to find these stocks that are over or undervalued. And if they have a hard time finding them, how are you and I going to find them?
Right, yeah. I never really looked at, the ETFs in that kind of manner. I just thought, a lot of people that tell me to invest in ETFs because, like, just on average, it just goes up on a more stable basis. And, personally, I invest in, like, Fidelity 500, Index Fund 500. I feel like that's a pretty solid one. And, yeah, just on average, I really do see what you're saying about how it goes up. It's not risky at all. It's, like, stable. And, like, on average, like, it will just go up. But what are your thoughts? This kind of pivots a little bit away from like ETFs, but what are your thoughts on options, and should people get into that?
So options are, I guess it depends on your level of risk aversion. So a lot of people just speculate on options, and I would discourage all types of speculation, whether that's in options, whether that's in individual stocks, whether that's in cryptocurrency. You can even speculate with bonds, Forex, right? These are all different ways to speculate. But in the end, it's speculating. It's kind of fun as a young professional when you're putting in, I don't know, $100,000, and you're like, okay, if I lose it all, who cares? But if I make 10x, then I can talk about it for years, right? So it's a little less of a big deal at that point. But when you're thinking about actually coming up with a nest egg for retirement, like, I would strongly discourage any form of speculation. That being said, like, options can be valuable if they're used properly. Mm-hmm. So, for instance, if I have a high risk tolerance, I might want to lever up my position in like the S&P 500. I have a well-diversified position, but it doesn't give me the expected return that I would like, and I'm willing to take on a little extra risk. I could use options to increase my expected return, but what I'm giving up when I'm doing that is that if prices go down, I'm going to lose a lot more than I otherwise would. So in that sense, I think options can be valuable, but use at your own risk.
Love the careful answer there. And I know there's many different types of options. You can have it out for a very long period of time, or have something called like a covered bear spread that if it doesn't hit at a certain time, it might be paying out correctly. Sort of what I wanted to get at is like, where is the line between these speculative options versus people that use it correctly?
So the correct way to use options is to hedge your risk or to increase your risk. Most forms of options, like you see when you're talking about like different spreads, things like that, you're betting on something. And every time you're betting on something, you're saying that you know more than the people that are pricing these. And you could get it right. You could make a lot of money. But it basically is coming down to you guessing. Whereas like, in my opinion, the proper way to use options, like from like an economic standpoint, or it is to use them to hedge your risk. So if you're worried about interest rates, you can use options to counteract any changes that could come from interest rates. If you're worried about inflation, you can use options to probably hedge inflation, things like that. So that's what I would say as far as options go. And just to give an example, so I teach investments here at Binghamton. So every semester that I teach investments, we have a paper stock competition. And so basically there's different groups in the class and during the semester you can pick different stocks, and everyone tries to earn the highest return, right? And one of the groups that earned the highest return this last semester used a whole bunch of options, and it was kind of around the time that we're getting news about tariffs and prices were just going crazy. And what they did is they used options in a way that if prices moved, they made money. So it was basically a bet on volatility. So if prices moved, whether that was up or down a lot, they made money, but if prices remained stable, they basically lost everything. And so they ended up having the highest return out of everyone in the class. But it was because prices went up a lot and then they went down a lot. And so there's this high volatility. But just as likely, they could have ended up with the lowest return in the class. And so whenever you're doing these speculative things, like you're going to win big or you're going to lose big. And if you're okay with that those high tails, if you're okay with winning big or losing big, like that's fine. But I think the important thing is to be aware of those risks.
Yeah, for sure. Yeah. I think like those opportunities are great, especially when, it's something positive, like making like, I don't know, 10x, 20x, the amount of money that you put in originally. But like for someone average, like an average investor like myself, I feel like it's more so like gambling rather than an actual investment because of my lack of knowledge. But, if used correctly, I feel like options is a very valuable tool. But something where I see a lot of volatility is crypto. Getting into that, I think like Trump coin specifically. That was a very interesting coin, and I actually saw a lot of millionaires get made like around me because of Trump coin, which was something interesting. What are your thoughts about like those meme coins, and do you think those have any kind of value to I guess like people that want to get into crypto?
So I actually teach a fintech class at Binghamton as well. My take on cryptocurrency generally is that most meme coins have little to no value. So if you think about cryptocurrencies, if you think about a stock, in finance we teach that the value of a stock is discounted future cash flows. And so what that means is that a stock is only as valuable as the money that you'll get in the future. If you're not going to receive any money in the future from investing in a stock, it should have zero value for you. And so cryptocurrency does not have any sort of intrinsical value, meaning that cryptocurrency doesn't pay you dividends. Everything that you have is digital, it's on your wallet. You could potentially use that for transactions, but as of now, you can't really buy anything with cryptocurrency either. That being said, the way that cryptocurrency can have value is through its network. And so if cryptocurrency networks are large enough, this provides value to the cryptocurrency because you can exchange that cryptocurrency with other people. So think about any social media. Like, would anyone use TikTok or Instagram if no one else used it? Absolutely not.
Mm-hmm.
And the same idea goes with cryptocurrency. If no one else uses it, it has no value whatsoever. And so this is part of the reason why Bitcoin has value, probably more value than it should, honestly, but it's because so many people own it. If I have Bitcoin, I know that someone else is willing to exchange Bitcoin with me because it has a large network currently. But the interesting thing about Bitcoin is that literally the only thing you can do with Bitcoin is send Bitcoin to someone else. And so if you're investing it, in my opinion, Bitcoin was made to be like a dollar, like currency, and you don't see yourself going out and buying dollars to make money.
Oh. Yeah, interesting point. I think the contrarian argument is that the same thing could be said about the US dollar. If nobody were to use cash, then it would be inherently useless.
Absolutely.
Mm-hmm. So how is it that like the US dollar has more value inherently than say these other cryptocurrencies?
Because it's used by, so the US dollar has tons of value because every single country uses it. Every international transaction is done in US dollars. And so its intrinsic value is incredibly high. It's even higher than probably any other currency, the intrinsic value. Like having a dollar, you know someone's going to accept that dollar. The other reason that national currencies have value is because of taxes. And so if you look on like the back of US dollar bill, it says something like the government will accept this bill, like it's legal tender. And so what does that mean? It means that if I owe the government debt in form of taxes, the government has to accept that debt in terms of that currency that I'm giving to it. Okay, and so I can give the US dollars and they'll accept that. I can go to Europe and use euros and give those to European governments and they have to accept that. With Bitcoin and cryptocurrency, there's no government backing it. And so the only value it can really obtain or attain to is from the sort of network effect where even though it's not backed by governments, there's enough people that decide, hey, we like this, we want to use it. And if there is a large enough network, then it can provide value. Just kind of like the same idea as social media. Like if you have enough posts on TikTok, enough content in Instagram, it's valuable. But if it's just you two, like how much fun are you gonna have posting videos for each other, right? Yeah, the one other thing that I will say about cryptocurrency is that I'm much more bullish on Ethereum. And the reason being is that I view Ethereum as sort of the Amazon of cryptocurrency. And so not to get into too deep of a discussion, but there's a disconnect between blockchain technology and cryptocurrency. So these are two different things. Blockchain is an actual technology. Cryptocurrencies are an application of blockchain technology. And people kind of mix up the two and use the two synonymously. But what Ethereum has done is they've created a platform that uses blockchain technology, that if I'm a developer and I want to do anything with blockchain technology, I can just build that on Ethereum's platform. And so it's basically a platform that has a whole bunch of apps. And so I can literally create a video game on Ethereum's platform, and users can go and use that video game, play that video game, and do everything using like just Ether and everything on Ethereum's network, which in my opinion, that provides a little more value than just sending Bitcoin to someone else. And so it's kind of interesting.
Wow, yeah. I didn't actually know that about Ethereum, but it is good knowledge to know if I ever do want to build something on top of Ethereum in the future. Are there any examples where
this is why you see like, so NFTs, for example, were a huge deal a few years back.
Mm-hmm.
So NFTs were all built on Ethereum's network. And so what it essentially is it's a what blockchain technology does is it's a really, really good and efficient way to track ownership of anything. And so this is why some people decided, hey, let's track ownership of like these digital images, right? And so if you create a digital image and sell it to someone else, they can actually show that they own that, like without a doubt. And that's sort of like the value of like the blockchain technology and why all these NFTs were built on Ethereum. Because if I wanted to sell digital work, I could do that in a trustworthy way through the Ethereum network, because it's technology, this blockchain technology that's underlying Ethereum, tracks ownership in a very, very efficient way.
Yeah, what you're talking about NFTs, yeah, definitely. Like in the beginning, I was very like skeptical on like the whole use cases on that, and like how people are actually able to like buy like digital properties like that. But I feel like nowadays NFTs are kind of dying out, and I don't really see it as much as I did, at least like in the past, like with certain things like costing a couple million or even more. It was kind of insane to see some NFTs like skyrocket in price, just because of like the amount of people that were interested in buying it. But do you feel like there is a future in NFTs like going forward?
I wouldn't say NFTs. I think there's a future in. Okay, so just to clarify, NFTs does not necessarily mean digital artwork. So digital artwork is a type of NFT. So for instance, what Ethereum can do is the network can allow its users to send anything digital to someone else. So use cases that I can see of NFTs, not digital artwork, but let's say I'm an artist and like a musical artist, and I create a bunch of songs. But I don't want to have to go through the record label companies to get my music to my fans. I could literally send a digital copy of my song to my fans directly through Ethereum's network, and they could give me cryptocurrency in exchange for that. And so it would be a way of just going completely around the musical industry and interacting more directly with fans. And another use case that's like very commonly put out is titles for houses. And so having bought a home fairly recently, you're probably not familiar with the process, but one of the things that you need to get the title of the house. If you don't have this literal physical document, you actually can't claim ownership to the house. And so what you do when you buy the house is you put it in a folder and then you shove it in storage, right? And so it's kind of a pain every single time someone transacts with the house. They have to go find that folder and they have to find that physical document, and then they have to give it to you. And on top of that, banks generally require what's called title insurance, which is in case there's something wrong with this title. And a lot of times to get a loan, you're required to get this title insurance. If you could just keep track of the ownership of that title on a blockchain, it gets rid of all of this altogether. So anything where it's important to track ownership, blockchains can do this incredibly well.
That's great. I think you touched on so many great points, especially with the differentiation. Did a great job at synthesizing this like complex topic into more simple parts. But I think that we should hop into our next segment, actually, which we'll call myth or money fact, where we'll put up conventional, more common like wisdom and put it to the test, see what your thoughts are. And especially since you're doing research in these fields, we think it'd be really interesting to see what your take is. The first one, we'll say a statement, and then we'll you could hear us out, elaborate on it. The first one we'll throw at you is the richer your friends are, the richer you'll become.
I would say fact. There's at least a correlation there. So a bit of my research studies whether the effect of having rich friends, right? So I find that if you have wealthier friends, you generally participate more in the stock market. Stock market is a way of accumulating wealth. So generally, you'll have more money. Also, there's other research that has shown that if you have wealthier friends, they generally, you have better access to jobs and things like that because these wealthier friends have better jobs, and so you have a better network, right? That being said, it doesn't mean that having wealthy friends causes you to have a lot of money or to have a good job. It's part of this is coming because the type of people that have a lot of money are friends with the type of people that have a lot of money. And so it's kind of hard to differentiate sort of what we would call the causal effect of having rich friends. The ideal thing that we'd want to do if we wanted to actually test this, we'd have two groups of people randomly assigned, and one of the groups of people, we'd introduce them to Jeff Bezos, Tim Cook, and a whole bunch of other CEOs and have them get to know them really well. And then 10 years down the road, let's see what happens to these two groups of people. That would be the test that we'd want to run, right? To see, okay, does having rich friends actually mean anything? But existing evidence at least suggests it probably does. But it's hard to tease out whether it's just rich people have rich friends or whether rich friends help you become rich.
Yeah, I think I agree with your point there. There's this quote where it's like, you are the average of the 5 closest people around you. So in that way, I do feel like, in a way, having rich friends around you, like, will eventually help you get there, even if you're not rich to begin with. But for our next myth or money fact, it's only experts can truly understand the stock market.
I would say fact again. So if you're talking about truly understanding the stock market, I would consider myself an expert in finance, and I don't truly understand the stock market. I feel like I have enough knowledge to make sound financial decisions. And if that's the question you're asking, like, I don't think you need to be an expert to make sound financial decisions, to understand kind of why stock prices are moving. So fiction for that, but if you truly want to understand all the ins and outs, there's only a handful of people that I would say truly understand every quarter.
Absolutely. The stock market itself is filled with so much, and I feel like it's a rabbit hole that keeps on going deeper. Like, there's more questions the more you figure out.
And there's so many niches too. And this is why, like, take an equity research, for instance. Like, if you work at Goldman Sachs, they'll have a team of equity analysts, and each person specializes in an industry. And this is because you can only become an expert or true expert in a very niche segment, in my opinion. It's you can definitely be well-rounded and understand how things are going on, but it's so hard to follow all the news for every single company, for every industry. It's tricky.
Absolutely. I think that brings us to our next myth or money fact, which the conventional wisdom is investing in dividend stocks is always safer. Do you feel like that's the case, having looked into the markets?
I would say on average, yes. That being said, like the safest thing is diversifying. So if I pick one dividend stock, it will be riskier. If I put all my money in one dividend stock, it will be riskier than buying 5 random non-dividend stocks. And the reason for that is if I split my money between 5 stocks, some of their individual risks, some will go up, some will go down, but that risk is going to be canceled out. Or at least some of that risk, I should say.
Okay, yeah, and for our last myth or money question, you need a lot of money initially to start in investing and financial planning.
I don't think that's true at all. So I would say definite myth on that one. So I think it's best to start investing at an early age, so that you become comfortable with investing it. So in my opinion, one of the biggest hurdles to investing is that I don't know what to do. What do I buy? How do I set up a brokerage account? What happens if a stock price goes down? Does that mean the end of the world for me? And these are all fears that are very real that people have that prevent them from setting up retirement accounts, prevent them from from investing in the stock market. And if you can get over these sort of psychological hurdles at an early age, or with little money, all the better.
Absolutely. I remember Dave Ramsey saying one time, if you just put in $100 a month into a mutual fund that has a 12% return, by the time you turn 65, assuming you invest at the age of 21, you'll be a millionaire. Just people I feel like fail to see the effects of compounding returns, and that kind of dissuades them into investing to begin with, or thinking that it's reserved for the rich, essentially.
Yeah, there definitely is an in-group, out-group mentality.
Absolutely. And that brings us to our last segment, actually, our very exciting lightning round. So we'll just be asking quick questions, one that might prompt quicker answers. And the first one that we have for you is, if there's any books or even podcasts you would recommend to someone that wants to dig into more of what we've discussed here.
That is a great question. I don't have a perfect answer. So I don't listen to podcasts as much as I'd like to. I have read a couple of books recently about cryptocurrency, which we talked about, and so I can recommend those. One is called Number Go Up, and the other, I'm trying to remember who the author is. He's the one who wrote Big Short, Michael Lewis. So he wrote a recent book about cryptocurrency that I found them both very interesting. They both have sort of an overall negative sentiment toward cryptocurrency, but they provide a lot of useful information, especially around the whole Sam Bankman-Fried episode going on. But yeah, sorry, I don't have a great answer for that one.
No, but for that book, I'm definitely gonna have to look into that. But for the next question, what is the best investment advice that you would have for somebody that's getting started, let's say under the age of 25, if you had to explain that in 20 seconds or less?
Set up a brokerage account, buy VOO, VOO, or SPY, SPY. Either one of them provides great diversification.
Love that. That's great advice. And I think the other end of the spectrum is, what's one financial myth that you wish everyone would stop believing in?
It's a good question. That it's hard to invest. I feel like there's this sentiment, kind of like we've alluded to, that uh, investing is for the rich. Like, and so that is one myth that I think people should should go away. Which is funny because when you asked me earlier, truth or fact or fiction, about whether you need to be an expert to know everything about the stock market, I said fact. But for investing in the stock market, I would absolutely say, like, no. Like, sooner you get started, the better.
Yeah, for sure. Because like time is money, and the earlier you get started, definitely like you'll definitely see more returns on that. But yeah, for the next question, what would you say is a common spending habit that you've seen in a lot of people, let's say the average person, that is definitely a big no-no?
That's a good question. I haven't viewed tons of information on people's expenses, but just sort of thinking off the top of my head, anecdotally, subscriptions are a huge one. And just in that sense, anything that has you sign up where you put in your credit card and they're like, okay, we'll just take something from you monthly. And you're like, oh, it's $8 a month. It's not a big deal. But then when you have like 10, 15 subscriptions, it adds up so fast. And then it's every single month. And that's one thing that I would, caution.
Right, that's huge. I remember looking at the study that said that if you add up every single streaming service out there, you'll be paying upwards of like $3,000 a month, which is crazy how there's even so many platforms out there.
It's crazy, yeah. So decide those which have most value to you.
I do want to touch on an interesting piece of research that I came across yours, which is whether your pitch of your voice influences you being potentially selected as a CEO. So what does the science have to say there? Is that, I guess, fact or fiction?
Yeah, so fact, I guess, is the short answer. And so the masculinity in your voice seems to predict whether you're likely to be a CEO or not. And sort of the anecdote of this is, is Theranos. It's Elizabeth Holmes. So I don't know if she was, how familiar you are with that, but she was notorious for when she'd go out in public speaking in a voice that was clearly not her own, or not her natural voice. And so there at least appears to be scientific evidence that you're more likely to be a CEO when your voice is more masculine.
Yeah, after this episode, I'm gonna have to start
controlling for gender. Because obviously, like historically, unfortunately, we've had far more male CEOs, but it's important, even controlling for gender. Those with more masculine voices within the gender are the ones that are more likely to be CEOs.
Interesting.
Yeah, I didn't even know that on the female side as well. But yeah, as I was saying, like after this episode, I'm gonna have to like start deepening my voice to one day hopefully become a CEO. But yeah, just to go into our last question, what is one change that someone can make like instantly right now on a day-to-day basis that will help just benefit their financial future?
Decide to invest, commit to saving a certain amount every month. And so when you get paid, first thing you do, save some money, then figure out how you're going to deal with all your other expenses.
Awesome. That's amazing. You have amazing advice, Brad. Well,
oh, thank you.
Again, thank you so much for taking the time to talk with you today. We really appreciate it.
Yeah, no problem.
Where can our listeners find some of the work that you've done?
Yeah, so you can search for me through Binghamton's website. I also have a Google site, so If you search Brad Cannon finance, I should be close to the top. There's not a lot of Brad Cannon.
Awesome. We'll link that in the description. Well, that concludes our episode today, Brad.
Yeah, and we appreciate you hopping on and having this lengthy conversation with us and providing value for all our listeners. But yeah, thank you so much.
Of course, yeah.
All right, yo. So that includes our episode 102. Peace.